We all have our own impressions of online dating, but at the end of the day, this is a company that nearly has a monopoly. With the exception of Bumble, almost every dating app of consequence belongs to Match Group.
And accordingly, they're generating 23% free cash flow margins, 20% returns on capital, and yet it only trades at a forward PE of less than 10. There's a big chasm between the substantial profits they generate and what the market is willing to pay for them.
Right. 3 years ago, this is a company the market valued at more than 150 times earnings. So for as overly optimistic as investors were then, now they are perhaps equally pessimistic, if not more so.
Well, folks, today we have an interesting one for you. I feel like we say that every single week, but that's just because we, of course, do not choose boring companies, right, Shawn? And it's also quite a controversial pick. Shawn's got a pitch for a stock that is as much of a battleground as any I've seen. And back in 2021, there were nearly $3 billion worth of shares being held short. And that number has come down a lot, but still roughly 5% of the company's shares are being sold short, meaning that people are basically making bets against the stock price. This contentious name is Match Group, a company I'm sure some of you are familiar with since they own Hinge, Tinder, Match.com, and a handful of other major online dating apps that we've all seen ads for, even if you've never used them. So to make a long story short, over the last few years, the bears have unequivocally been winning out as Match has hit some roadblocks in growing their user base, yet the company is still very profitable today, and if they can prevent the business from continuing to decline long term, I think the stock will likely look very cheap in hindsight. So with that backdrop, Shawn, how about you tell us about the online dating industry more generally before narrowing in on Match Group?
Hey, Daniel, good to see you again. I'm not sure whether the audience will like this pitch or not because I'm a little conflicted about it myself. But boy, did I learn a lot in doing the research on it. The online dating world is such a unique business, and the incentives and realities of these platforms are maybe not the same as you'd think with some of the other network effects we've looked at, like with Reddit as a social media company or with Uber as a two-sided ride-hailing network. And for example, one peculiarity of this industry is that across the board, dating apps are seasonal. They're more popular at the beginning of the year, post New Year's resolutions, and then they fall off at the end of the year just before the holidays. So there is very much some cyclicality to their engagement. It's not steady. And another interesting aspect is that as a company that primarily operates as a mobile app selling subscriptions, App Store fees end up being particularly consequential for Match Group. And that is to say, the fees that Apple and Google take from these in-app purchases, the cut is usually about 30%. So Match could really benefit materially from some of the lawsuits that are pending out there that are trying to push big tech companies to relent on the fees that they take from publishers within their own apps. And because of the transition to dating services mostly being used via mobile app, as opposed to online via a desktop like 15 or 20 years ago, Match's gross margins have actually declined for several years as the business has scaled, which is really the opposite of what you would expect for a software business because more people were using the app where there are these App Store fees. And previously, the checkout process would have occurred on a web browser on people's computers outside of the purview of Apple and Google's app stores. And other app-based companies we've looked at, like Reddit, rely on advertising, which is an indirect form of monetization that actually bypasses app store fees. And even with our other portfolio holdings like Uber and Airbnb, you might be wondering if they also face these app store fees. And the answer is largely no, because they're rendering services that are delivered in the real world. So either home rentals or car rides. And app store fees really only apply to in-app digital services like Tinder or Hinge subscriptions. So there's sort of this call option baked into the stock where the company would be materially more profitable if the status quo in app store fees is to change. But I wouldn't want to bet on that as a core part of the thesis, but it's certainly involved in the equation here. And there is this potential upside where if regulators move to support mobile app developers over app store monopolies, Match's profit margins could increase. And I would think that possibility is almost certainly not reflected in the stock at current prices, especially at the beaten down multiple it's been trading at.
It feels like just a call option you have if you would buy into Match Group. And I'm honestly excited to learn more about the business today. From all that you've told me, there are very compelling bear and bull arguments, and in some ways similar, but also very different from any other company that we've looked at prior on this show. And with Spotify, for example, you can count on some percentage of users sticking around for many years to come. Whereas with dating apps, the whole purpose is quite literally to get them off the app eventually. Now, not everyone uses dating apps to find long-term relationships, so you could have someone use it indefinitely to look for, hookups and other low-stakes connections. But again, you have a business where generally speaking, your customers are trying to eventually stop using your product. That's a hard place to be in, and I guess it makes customer acquisition top of mind. And on top of that, trying to explore in what ways, if any, you can retain customers and then, convince them to stick around. I've noticed some of these apps have features on finding friends as opposed to just finding dates. And that might be a slightly more reliable model on paper, but I also doubt it's a huge part of the business either. There's a real cost to dating. I mean, a given date can cost somewhere between, $20 to $200. And if an app can help you laser in on more meaningful dating opportunities to save you from wasting money on, well, a bunch of blind dates, I would consider that a big value add. But friendships are much lower stakes, and typically, I would think that people are more content to roll the dice on their own ability to make friends. So there's probably less chance for value add in the same way. Although I know people who use Bumble to find friends when they move to, for example, a new city, and it worked out great for them. So perhaps there is a bigger opportunity than I give it credit for.
I think you're onto something there. This is maybe not a long-term compounder like a Amazon or Meta, but Match Group definitely has some things going for it. And across their portfolio of apps, they are the go-to apps that people rely on to find love and connection. And that's just powerful stuff. At the simplest level, they command a lot of eyeballs, which is a very valuable asset to have.
Well, why don't you help us get up to speed more on Match Group itself? So we could jump either right into the business model, but when we talked offline, you mentioned there, let's say, difficulties in finding the right CEO. And I think they had another CEO change just recently, right? So maybe you can talk a bit about that.
I think you put it nicely. It would probably be more accurate to say they've been playing hot potato with the CEO position. And for the last decade, no one has been able to hold the job very long at all. They've cycled through a number of management changes, but the latest change is perhaps the most promising, if I'm being cautiously optimistic. Spencer Raskoff now helms the company after having co-founded Zillow and served as its CEO for years. And he was actually also on the board at Palantir. So he has a pretty diverse corporate background, to say the least. And so the question he's trying to address now is proving whether he can lead a turnaround beyond founding a great company as he did with Zillow. And on that point, he has put his money where his mouth is. Raskoff bought $2 million of stock within his first couple of days of joining the company. And then he bought another $1 million after the first quarter of this year. So even at a time when the company is doing a 13% headcount reduction, he is telling the market pretty confidently that he genuinely believes in the company and likes the current valuation. And this new leadership is one of two important catalysts for us to think about, I would say. And this is really going to be at the center of the turnaround that Match's shareholders are hoping for, with this second part of this turnaround stemming from their plan to conduct aggressive capital returns. And for context, in December 2024, Match committed to returning more than 100% of their free cash flow through year-end 2027 via buybacks and dividends. And that's very substantial. At today's valuation, that equates to over 25% of the company's overall enterprise value and more than 35% of its market cap being returned to shareholders from the company's cash flows. And the stock is still trading at a very discounted valuation of just 8 times its expected free cash flow over the next 12 months and about 10 times trailing free cash flows. And so that's a whopping 10% free cash flow yield at current prices. I think that's the highest free cash flow yield of any company we've looked at. And it's almost triple the yield it traded at just 2 years ago. So that is ultimately a testament to the substantial amount of cash that Match is able to generate relative to the current market valuation of what the market is willing to pay for a dollar of Match's earnings, as well as really the power of doing capital returns at depressed valuations. A lower stock price is going to make the dividend and buyback yields much more material and create much more value for shareholders. And to the extent that these returns prove sustainable, the market should eventually recognize that and reprice the shares. I mean, that is really sort of the hope of doing these capital returns, is proving to the market that you can make good on an investment in the company.
It feels like the total opposite of Ferrari, who buys back stock and is paying a dividend, but at prices where it just barely moves the needle. So that's one of the things I was most curious about. And to my surprise, Match looks like a solid cash machine, especially relative to its current valuation. But my understanding is that dating apps are typically free, and I don't think that it's a common thing to actually pay for them, or at least you don't meet many people who would, proudly boast about paying for Tinder Premium. So I guess it still seems to be kind of taboo to pay for a dating service, with the idea being that it kind of signals, hey, I'm someone who has trouble getting dates offline, but also online by just using the regular free service, so I gotta pay for extra boosts. Not sure if that's still the case, but I think that has been the perception in the past. And if that's the case, the question that keeps coming to my mind is, who is paying Match Group and what exactly are they paying for?
It's a freemium model. So yes, anyone can use the dating apps for free, and that is going to be good enough for most people. But there's sort of a power law in not just dating spending, but in mobile app spending generally. A small percentage of people make up the vast majority of spending. And with Match, this is typically a small cohort of male super users paying for premium features like unlimited likes and greater visibility. And it's a pretty wild stat, but according to Apple itself, back in 2017, something like 0.5% of App Store users drive 54% of total spending, with the top 8% of users driving 95% of spending across the App Store. So presumably there's a somewhat similar dynamic on Tinder, which has over 90 million users worldwide, and probably a small fraction of them are driving most of the monetization.
Wow, that's some serious level of concentration. And I could imagine that the risk for Match Group might even be a bit higher than for Apple's App Store, since App Store users or their super users tend to spend it either on in-app purchases in games that they play excessively or new games. So there's kind of like a never-ending pipeline of things to pay for and no competing app store either. And for Match Group, I think the risk would be that it might not take much for this small number of users who drive most of Match's revenues to migrate away from the platform. And in comparison to the App Store, there are many other options than Tinder, although to be fair, Match owns most of them. And building and scaling a completely new dating app is quite difficult. I mean, Tinder benefits from having the most users of any dating app in the world, which makes it a better user experience because, the network effect is stronger, resulting in more options. And it's just hard to build a network effect from scratch because there's not much the competition can really do to differentiate their platforms, right? The only thing I can think of is leaning more into specific niches like farmers only or Christian mingle, where a specific demographic is drawn to a given platform. But by definition, these platforms can't have the same universal appeal and the scale of something like Tinder, And if you try to create a new Tinder from scratch, most people are going to be like, well, okay, but I already have Bumble, Tinder, and Hinge, so why should I give your new platform a try? Unless it's targeting a niche. And then again, in that case, a niche focused dating site just isn't a serious competitor to these broader services like Tinder.
That's a really good way to put it. Tinder has this unique first mover advantage in having scaled across college campuses. And as you said, I think if competitors try to recreate that now, it would be virtually impossible. The cat is out of the bag. When Tinder was brand new, it was this exciting novelty for people to be asked to join. And it was something different and new to be a part of. It was exciting. And today, there's really no shortage of options, obviously, with many of them already belonging to Match's portfolio of dating sites and apps. And the more niche you go, the harder it becomes to hit profitability because a certain scale is required to be profitable for a freemium business. And that's really true for any SaaS business. So That's why, to some extent, Tinder's network effect provides a moat, which is not to say their network can't go in decline. Plenty of previously vibrant network effect companies from AOL to MySpace have seen their networks go into terminal decline. So having a network doesn't permanently guarantee success, but it certainly erects barriers to entry that make it more complicated for new competition to come in and erode returns. And another thing that I think gets misunderstood about Tinder is that it has a very high churn rate compared to services like Spotify, Netflix, which looks bad, but it also has high rates of reactivation. And that reflects the nature of dating. Users might delete Tinder or Hinge while in a relationship for 6 months and then rejoin if things don't work out. And interestingly, while it may seem like it's against the company's incentive structure to have people actually get married, ends up not entirely being true, because when newlyweds are inevitably asked about how they met, if they're willing to be truthful, they'll say that it was through Tinder or Hinge. And I know that I have at least one set of recently married friends who that immediately comes to mind for their meeting story that they told everyone about at the wedding was about how they met on dating apps. So what that does is it really effectively turns people into lifelong evangelists for Match's products, inspiring others to try these apps after seeing that, hey, it really does actually work for some people. And if it worked for my friend, maybe it can work for me. And don't get me wrong, it is not the best business model in the world. That's why I say it's not a compounder. They face competition, there's churn, there's market saturation, and then you have this structural backdrop that I think we should probably get more into later in the episode at some point, is that younger generations are dating less and less. But at the same time, still, the company has, in my opinion, better unit economics and maybe stronger moats than the market is giving them credit for at the current valuation.
So tell me, from understanding the business model, right? I'm imagining Match Group as effectively this large holding company encompassing a bunch of different dating networks that, in a way, add together to form one giant network from a business perspective. So how about we linger a bit longer on that point? And if you want to take a moment and tell us more about the Match portfolio, I would also appreciate that.
Yeah, well, Tinder, after launching in 2012, is very much the company's flagship brand, known best for offering folks the chance to swipe left or right on a potential match, and that either is a way to decline them or show interest in connecting. And Tinder has the perception of being more of a casual app, not as much for people seeking serious relationships. But management is working pretty desperately to change that perception. And they've said that the perception that Tinder is mainly for hookups has decreased by 12 percentage points in the US, according to their own polling, since they began rebranding efforts about 2 years ago. And regardless of that, though, if you ask someone on the street, they will probably still tell you that Tinder is a hookup app, for better or worse. Whereas Hinge, which was also launched back in 2012, but was acquired by Match in 2018, this is a company that's positioned for relationship-minded individuals, as they like to say, and that's particularly focused on millennials and younger generations in English-speaking markets. And really, it's interesting. They like to brag that they have this Nobel Prize-winning algorithm that the app is driven by. And you see this most clearly with something called their most compatible feature, which, based on that algorithm, suggests one ideal match per day. So rather than throwing 500 names at you, it's one that they have a lot of conviction that you'll like, and it's every single day. And I see the value in that. And so testing has shown that these matches are actually more likely, statistically speaking, to lead to phone number exchanges that take the next step toward real dates actually happening, as opposed to just the regular matches that occur on the app. And Hinge's signature tagline that some people might be familiar with is designed to be deleted. And so it offers features like video prompts and voice notes that give users more ways to differentiate themselves in the dating process, but it also requires more work. And the average profile setup time is approximately 3 to 4 times longer on Hinge than Tinder, which is why it attracts more serious daters and doesn't have the same rep for hookup culture. And Hinge is really the bright spot for Match. It's this emerging crown jewel. And in their investor day last year, management told shareholders that they think Hinge is on its way to becoming $1 billion revenue business after seeing exponential user growth in the last few years. So Hinge, in many ways, is the next big thing in dating that could actually disrupt Tinder, yet Match also owns it. So they're ultimately positioned as a beneficiary of these longer-term trends in online dating activity, even if they partially disrupt themselves. And so beyond these two core brands, you have these more niche platforms like Meetic, which is mostly popular in Europe and targets older users who are over 35 and who are focusing on serious relationships, whereas OkCupid takes this more fun Q&A approach and has what you may call a younger, more culturally progressive user base. And then Archer is Match's alternative to Grindr. And I should say that Grindr is the leader in the LGBTQ dating niche, but they've refreshed the Archer product a good bit recently. So they're hoping to take some market share back from Grindr. Then there's Our Time, which is the largest online dating community devoted to singles over 50. And beyond that, you start to get into Match's even more niche platforms that they call their emerging brands. So this includes Chispa, which is a Latino dating community, BLK, which is a Black dating community app, Upward for Christians, Par Perfecto, which is Brazil's top dating app, and Hawaii for the Muslim dating community. And you've also got platforms like Azar that they acquired in 2021. And Azar is this one-to-one video chat service with real-time language translations that's primarily focused on Asia. And then also one of their top platforms is called Pairs, which is specifically popular in Japan. So the point being, there are all kinds of more niche platforms based on age, geography, and sexual orientation, with Tinder and Hinge by far having the largest reach and best potential economics thanks to their scale. Even Einstein had blind spots. That's why modern science is built on the idea of peer review. Investing may be more art than science, but that doesn't make peer feedback any less valuable. The tricky thing is finding qualified people who are interested and willing to help vet your investment ideas. That's why we built the Intrinsic Value community. It's a place to connect, share ideas, learn, and get feedback. Nobody ever wishes they'd spent more time buried in spreadsheets, but connecting and building relationships with others who may be smarter on a topic than you, but who are also schooled in value investing, that's valuable. We make spots in this exclusive community available in cohorts every few months, and last time around, our 30 available spots filled up pretty quickly. If you're interested in our next cohort, which will be even smaller, you can join the waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. Look, every hunter, camper, and backpacker needs one of these. That is a Harvest Right freeze dryer, which lets you preserve your own meals and snacks. It's perfect for your next backcountry adventure or hunting trip. You can fuel your adventure with freeze-dried strawberries, bananas, pineapples, and even full home-cooked meals. No more relying on expensive store-bought, preservative-packed food. You can also preserve wild game with your Harvest Right freeze dryer. That's right, take control of your harvest by freeze-drying venison, elk, or fish, so you will always have high-quality protein ready to go. And your pets will love the freeze-dried treats too, just like my dog Riley. Freeze-dried meals are lightweight and long-lasting, staying fresh for up to 25 years, yet they taste just as good as the day you made them. Whether you're hunting, camping, or prepping for emergencies, a Harvest Right freeze dryer keeps you ready for anything. It's like having extra cash in your portfolio to take advantage of downturns in the markets. That's how I think about it, at least. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get Get Started with Stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
Talking about the economics, I would love to know the economics of these smaller platforms and to what extent there are synergies when they get merged into Match Group. Because if these platforms couldn't stand on their own, but you can plug them into Merge Group for, streamlined HR, marketing, and software infrastructure, I think that would be quite compelling. Match would essentially be this, powerful serial acquirer that's uniquely positioned to absorb smaller platforms and then integrate them into their bigger ecosystem where they can benefit from, cost synergies and more financial firepower to boost their brands. It's almost like, well, that comparison might seem a bit crazy at first, but wait a bit. It's a bit like LVMH, which is focused on absorbing promising luxury brands and leveling them up within the LVMH corporate structure. I know it's a bit of a stretch, but is that how you could see, or is that how you see Match Group?
No, I agree. I mean, in short, Match is the only player with enough scale and data to be a serial consolidator in the dating space. And as such, every incremental app that they acquire both benefits from and reinforces that scale moat, helping them drive excess returns that smaller independents simply can't match. Because like we said, with a freemium business, you need a certain scale. And if you can't get to that scale, they may never be profitable. So the LVMH comparison is a really interesting one. There are obviously some big differences between software and luxury retail. And there's much more cannibalization in the dating app world, but still there's some merits in looking at both of them through this framework. And there are only so many people interested in using dating apps at a moment in time. And realistically, they use multiple apps at once, but they only have so much time to dedicate to any single app. With the point being, every minute you're on Tinder, you're not on Hinge, which takes away from Hinge's business. And that is different from LVMH because buying a Louis Vuitton purse doesn't really necessarily have any bearing on your decision to go buy Moet champagne or Tiffany jewelry. They are different types of purchases. And there's obviously some overlap across LVMH's brand portfolio, but each brand really stands on its own. And like I said, the purchase decisions are mostly not mutually exclusive. And on the one hand, consolidating platforms together increases Match's overall reach, obviously, and the size of that network. But I think the unit economics are less attractive because, like I said, there's a lot of overlap in users across these platforms. And any organic growth in one app almost comes at the expense of another, since the dating app industry itself is relatively mature at this point. And not to say there's no organic growth, but acquiring truly new and unique users that don't already have a presence on any of the company's other apps is harder and harder for them to do with each passing year. So it goes without saying that LVMH is a much, much better business than Match Group. But the idea is the same in the sense that, as you put it, you have this holding company focused on a certain niche that is sort of like a serial acquirer, snapping up brands and trying to elevate them through their existing ecosystem.
If I'm not mistaken, though, Match itself is also a spinoff, right?
In 2018, Match spun off from IAC, and around that time, Match purchased Hinge. So while Hinge is now the shining star in Match's portfolio, it also wasn't an organic development. They did not build it in-house, in other words. And that's an important note to make because there is a big difference between companies that have a culture and track record of successful innovations and new product launches internally versus being an acquirer trying to make attractive acquisitions at fair prices. But to go back to the IAC backstory a bit, really Match Group's entire life arc is intertwined with IAC, which was born out of Barry Diller's ambition to build an anti-conglomerate, as he put it, that incubates digital businesses and then spins them out. So rather than acquire and develop businesses to hold forever, kind of like the Berkshire model, IAC exists as a vehicle to buy or build up companies before spinning them off to shareholders. That is their approach to creating value. And the list of companies that once belonged to IAC is actually pretty impressive, including Tinder, of course, but also Expedia, TripAdvisor, Ticketmaster, and LendingTree. And those are some familiar names. And now today, IAC is still publicly traded and controls Care.com and Vimeo, and it also has substantial stakes in Angie Home Services, MGM Resorts, and then the car sharing service Turo that people like to call the Airbnb of car sharing. And as far as we are concerned, the story begins when Match.com launched in 1995. It became an IAC property in 1999 when Ticketmaster Online, which, like I said, is an IAC subsidiary, acquired the site. And over the next decade, IAC rolled up almost all of its relationship-focused assets into this dedicated division that it branded as Match Group in 2009. And then they just went on an M&A tear. They acquired People Media, SinglesNet, and most notably at the time, OkCupid for $50 million in cash in 2011. And by 2015, IAC had decided to offer up 14% of its stake in Match Group in this late 2015 IPO. Yet it kept all of its Class B shares that had super voting rights, so they could continue to have full voting control over the company. And post-IPO, that left this really weird structure where IAC owned 86% of Match's equity, but had roughly 98% of the voting power. And the structure was just so messy because where Match reported as a separate public company, they were also a fully consolidated subsidiary on IAC's books too, because IAC has majority control of the company. And over the next few years, IAC would periodically be tempted to sell small blocks of Match to fund their new ventures and buybacks that they're trying to do. But it continued to retain majority control until 2019, when they signaled it was finally time for a clean break from Match. And they announced these plans to distribute the remaining stake in Match directly to IAC shareholders, such that when the transaction closed in June 2020, the shares of IAC someone owned before the deal turned into one new share of IAC, holding all the same assets except online dating, plus 2 shares in Match Group.
Sounds quite complex. That's true. And perhaps you should talk about some of the risks, because I think this is a company where that matters a lot. I mean, when I think of all the risks Match Group could face, it feels like there are so many of them. It definitely makes sense to go over them one by one and then see how big of a risk that actually is, especially in the long term. So this isn't exactly a company with a long history of operational excellence, and all their CEO turnover isn't inspiring either. And then there are some major question marks, at least in my mind, generally about the future of online dating and what that might look like. But I'll pause there to, let you speak, Shawn. So what risks we really should focus on, and what is the one that you're most concerned about here if you look at the long-term horizon for Match Group, or even short-term if you think of this more as like a turnaround play?
It always helps to ease one's mind when we can look back with a company like Adobe and say, okay, almost all their revenue is from recurring subscriptions with clients who, in many cases, have used Adobe products for decades. So even if generative AI changes the way we edit and produce content, we know that Adobe is in a position to respond to those changes from a place of strength, even if they don't end up being a winner in the way we think they can continue to be. And with Match Group, though, it all feels so speculative because online dating barely existed 20 years ago. And the services are largely interchangeable. We know pretty objectively that there's very little platform loyalty. Most people cycle between multiple dating apps. So when we think about the future with augmented reality and virtual reality and AI agents, it's hard for me to feel as good about Match Group's ability to retain the advantages that it might currently have. But we also don't have to look out into the distant future to find abstract concerns with this company. I mean, part of what has crushed the stock in recent years is that even though top line sales have kept growing, the underlying circumstances look less and less healthy, which is to say the number of people on Tinder who pay for any of the premium services has significantly declined. And from Q1 24 to Q1 25, for example, the number of paying users fell 6%. And so the way they've kept revenue flat to growing is because they've raised prices dramatically for ongoing payers. But that's not sustainable because you can only raise prices so far if your volumes are falling off with each increase. And there's really only so much juice that can be squeezed without growing the base of paying customers that fundamentally represents their earnings power. And I should say that it's possible that Match Group is partially disrupting itself Some of the decline in Tinder payers could be explained by a 19% year over year increase in folks paying for Hinge, though Hinge is growing from a much, much smaller base. And in other words, Hinge is growing, and maybe that's partially coming at Tinder's expense to the extent that users interested in serious relationships give up on Tinder and migrate to Hinge. And we've got a chart up on screen showing the numbers for those watching on Spotify or YouTube. And I mean, it's not pretty. To be truly bullish on Match Group long term, I think you have to believe that Tinder's decline can stabilize or be fully offset by Hinge, which it's not totally implausible. But like I said, the picture, it looks rough.
So to me, I hear a few different risks and arguments for the bears. One being that, this is a value trap because Tinder is in secular decline. It is possible for a reverse flywheel to occur that destroys a network like Tinder if people increasingly see it as a place for cheap hookups or a platform that is just flooded by spam and AI. And that seems like an industry problem too, not only one for Tinder, but if Tinder profiles are much faster to create, then there are fewer barriers to spam than, let's say, on Hinge, for example, where you mentioned it takes 3 to 4 times the amount of time to set a profile. And then I also see a risk where Match gets punished even further if Hinge hits any road bumps. So it sounds like there's a lot of optimism that Hinge can absorb losses at Tinder while maybe even taking market share from the company's main competitor, which is Bumble. So yeah, any stall out at Hinge could wipe out whatever enthusiasm there is left for the stock that has fallen pretty far from its pandemic highs. So I think there are a lot of things to consider when going into this.
You're not wrong. It's been pretty incredible to see the change in the market narrative with this company. Back in 2021, investors were paying more than 130 times earnings for the stock. And now the shares can't get really any love at a very, very small fraction of that multiple. So on that network effect point, it is just structurally harder to maintain a network effect where there's so much churn in the user base, even with these reactivations that we see. That churn cycle creates opportunities for competition. And if you use mostly Tinder for a while and then got into a relationship that didn't work out, you might then focus on Bumble as a way to change things up or look at maybe getting different types of connections than what you're getting before, which is just to say there's not a lot of ongoing loyalty to any of these platforms. And more realistically, that person is probably using multiple apps, like I said, with little loyalty to any of them. And AI spam is a particularly big challenge here. If you have the biggest network effect, but your platform gets associated with spam that ruins the user experience, your network effects can evaporate pretty quickly. And I wouldn't think that it's nearly as sticky as some of the other network effects that we've explored on this show. And another thing to mention on top of that too is compensation. While management has presided over a 50% decline in the stock price in the last 3 years, its previous CEO earned $45 million during that time. And that's the kind of thing that's just extremely frustrating for long-term shareholders who also try to think like owners of the business. You're paying a huge price for leadership that was ultimately ineffective. And as a percentage of sales, stock-based comp has nearly doubled since 2021. So the buybacks are great, but they're less productive to the extent that they're just offsetting excessive management comp. And obviously you alluded to it a few minutes ago, but there are more abstract risks around the future of dating. Will AI girlfriends, for example, take a percentage of the population off of dating apps? I mean, it sounds crazy to say, but that possibility seems much more tangible today than even just 2 years ago, given the progress we've seen in LLMs and image generation. And maybe first dates will occur in Zuck's metaverse. I mean, I'm skeptical about that, but I do think this is a time for humility. I don't know with a lot of confidence what the dating world will look like in 5, 10, or 20 years. And I don't know if we'll still be scrolling and swiping and using apps in the same way. I mean, I think it really could be dramatically different. And that is what the market is antsy about.
It's definitely uncertain, but I just deeply hope AI girl or boyfriends won't become a thing. But we already see a significant shift in how dating works today. That's kind of what he's saying here. And there's all this data on Gen Z dating trends where Gen Zs are going on fewer dates than, past generations and not even dating at all in some cases. To me, that's almost more troubling than the idea that some percentages of Tinder users are going to resign to just having chatbot girlfriends, I think this is something that might be long-term concerning.
You're right. The stats are not inspiring. A survey conducted by the Service Center on American Life found that only 56% of Gen Z adults said they were involved in a romantic relationship at any point during their teenage years. And that's just a remarkable change from previous generations. More than 3/4 of baby boomers and Gen Xers reported having had a boyfriend or girlfriend as teenagers, while 44% of Gen Z men today report having no relationship experience at all during their teen years. And so that's double the rate for older generations. And Gen Z is obviously very different than any other generation, but we have seen Match trying to do some things to address that. Gen Z daters tend to prefer lower pressure interactions. And so the team at Tinder recognized that and developed features like double dating that allows users to team up with friends and match only with other pairs. And I think that group dynamic just helps to make things a little less awkward and break some of the barriers that can arise with one-on-one matching when you're doing something in a group setting. And like I said, Gen Z doesn't fit the traditional relationship mold to such an extent that many in the Gen Z dating pool don't even necessarily prefer the term dating. That, situationship has become as common of an expression, and or even just saying that you're talking to someone. That's another way of saying that you're in a relationship without something as formal as a dating label on it. And relationship structures then are just less formal, which is probably partly why fewer people say they identify as being in a relationship in a classic sense. And I guess the point is that this doesn't have to be devastating for Match Group if ultimately we're arguing about semantics. Tinder and Hinge are primarily used by millennials and Gen Z. Whether they call it dating or not, using a service to connect you with other people, I think will always be valuable, and maybe even more so in a world that's flooded by AI spam and virtual reality.
It's really interesting to me to think about how companies can change behavior at the societal level. For example, in 2012, if you had surveyed 1,000 people about whether they had ever paid for ride hailing over the internet, I think almost everyone would have said no. And so, going off that alone, you might have thought, okay, the ride hailing market could never grow beyond just taxis and that it wasn't something that the internet could disrupt. But clearly, with Uber, you would be totally wrong about that, such that the total addressable market for ride hailing has grown dramatically because Uber has unlocked new forms of spending and behavior that didn't really otherwise exist. People who had never used taxis now use Ubers because of the convenience they deliver. And so the point I'm trying to make here is, I guess, that the online dating industry does look very saturated in North America and perhaps also in Europe, given that the whole industry is basically stalling out. And the growth that Hinge is seeing is, to a large extent, just coming from Tinder or at Tinder's expense, which nets out for Match. But I do wonder if there is still a larger group of potential users of online dating apps that, for whatever reason, still remains untapped. I saw a Pew Research study saying that only 3 in 10 adults had reported ever using a dating site. And I don't know, that sounds quite low to me. But also, that figure has remained unchanged since 2019, which I'm sure explains why online dating as a whole just hit a plateau. And that's a conundrum here, right? How do you break the stigma and make online dating more attractive to the rest of the dating population? Something like 50% of people between 18 and 29 have used dating apps, but only 20% people aged 50 to 64 have, and only 13% of people above the age of 65. So naturally, as you move up the age chart, a higher percentage of people are married and therefore not, using dating apps or dating at all. But still, I'm sure there's room for the share of 65 plus year olds who've used online dating to rise beyond 1 in every 10. And even if it went to 2 in every 10, that could be millions of incremental new users.
It is funny because for a lot of industries and companies, the story that's told is that there will be more adoption by younger users. That's the core focus and narrative. But it's the opposite in online dating. As you pointed out, usage of online dating by folks in their 20s is very saturated, but very underutilized by older cohorts, even when you adjust for the fact that a higher percentage of older people are not looking for relationships structurally. And part of the bull thesis for Match then is that the demand for senior dating services is higher than ever as America rapidly ages. By 2030, there will be more residents over 65 than under 18 for the first time. And according to Pew Research, 30% of Americans over 50 are single. And for people over 65, it rises to 36%. And many of them are as romantic as ever, I'd think, and hopeful to find love in whatever season of life it finds them. And yet, when polled, something like 75% of singles, so not just the general population, but singles over 65 years old, said they were not looking for a relationship. And again, that's a complex thing to diagnose, but you have to think some chunk of that are people who would actually be willing to look for a relationship under the right circumstances, but they just don't know where to begin, which is where the right online dating services can come in for them. And the thing is, 65-year-olds today have had 10 years or so more experience in using the internet than 65-year-olds a decade ago, right? I mean, it's funny to joke that boomers aren't tech savvy, but I do think it's increasingly less accurate to frame older generations as being total Luddites. Someone who is 60 today has potentially been using computers for over 40 years. So maybe they're not scrolling TikTok and Snapchatting, or maybe they are, but they're definitely not offline in the way that past generations of older people have been. And the reason I say that is I think that it makes it more likely that the percentage of older adults willing to experiment with online dating will rise, providing at least some room for optimism to me that with the right branding and marketing, there are many more people who can be drawn to online dating than currently utilize it.
I figured this episode today might take some interesting turns, but I wasn't expecting to go so in depth on the potential to get people's grandparents on dating apps. But I appreciate the point though. And if there's a tailwind like this for the industry, I think Match should reap much of the benefits since, after all, the dating app market is basically a de facto duopoly, with Match Group and Bumble collectively wielding control over close to 70% of the entire market share. But I do think we should discuss a bit more on what exactly makes dating such a hard industry to invest in. Famously, a few years ago, A16Z investor Andrew Chen published a blog post titled "Why Investors Don't Fund Dating," where he argues that the reality is that securing funding for a dating product from mainstream venture capital investors is incredibly challenging. A significant portion of angels and funds categorically refuse to invest in the dating category, similar to how many avoid the gaming, hardware, and gambling sectors. And some of the reasons why are what we have already discussed or covered today, but just to emphasize them again, for starters, he talks about the built-in churn in these products, where the better your dating product works, the more of your customers will churn, and every churned customer is a new customer you will eventually have to acquire just to get back to even. And that's something you mentioned before. On top of that, paid acquisition, so basically the amount that must be spent on advertising to get someone to try a dating app, and city by city expansion have historically proven to be very expensive. And then there's the stigma that effectively limits virality. Dating apps, they aren't social in the same way that Facebook or TikTok are, since your friends aren't naturally inclined to sign up on Tinder and then invite you to join the app, because dating is such a private and also intimate thing that would be kind of awkward, I think, if you would just sign up and then invite a friend to also join. It's way easier to send someone a cute cat video that they have to download an app for to watch, and then bam, they're basically hooked on the TikTok algorithm. That's just way more difficult for any dating app.
The online dating industry very much has some issues that it needs to address, and some are inherently more addressable than others. So for example, there's a bit of a conundrum in that having more options, both in terms of dating apps and then just in potential mates on those apps, is not necessarily synonymous with a better user experience. In the same way that if you go to the grocery store and there's 20 different types of mac and cheese, that's actually maybe not a good thing, because it just creates all this decision fatigue. And like I said, that's sort of the opposite of what you would expect with maybe a normal network effect company where more people, the better. With Uber, having more drivers available to pick you up makes the service a better experience. And again, that is typical of a strong classic network effect. More supply, more people in the network, that's going to make the service more valuable. But in the past few years, dating app fatigue has emerged as a real issue for Match Group that needs to be addressed if they're going to rejuvenate engagement. And in 2023, we keep quoting Pew Research here, but they had another survey showing that 46% of Americans reported their overall experience with online dating as being negative, which was up from 42% in the same survey from 2019. And even more concerning than that uptick is that more than half of women reported a negative experience. 11% of women said that they received threats of physical harm, and 42% of younger women between 18 and 34, according to Pew, reported receiving explicit messages that they didn't consent to. So, I mean, that type of stuff is just totally unacceptable. And it's still happening every day. And 70% of people think it's common for folks to lie on dating apps to make themselves more appealing. So again, that's a harder problem to solve. And it undermines people's willingness to continue using and trusting online dating services. So as I was saying, having nearly endless options results in this decision fatigue. And the reality is that women tend to get many, many more likes and messages than men do. Men are typically the ones on these apps trying to catch women's attention. But that can be pretty overwhelming for a lot of female users. And on top of that, it's not just overwhelm. Something like 53% of adult women believe that online dating is just simply unsafe. You can't have half the women in a country believe that dating services are unsafe and think that the business will ever scale much beyond its current size. So they have to change those perceptions. And on the bright side, I will say the percentage of people who think online dating is unsafe drops from over half among those who have never used a dating app to being less than 30% among those who have used an app at least once. So people's fears do tend to be alleviated pretty quickly after giving these apps a try, but still overcoming those initial stigmas makes incremental growth very challenging and just very expensive.
I'm asking myself if not online dating apps themselves are kind of part for the reasons why Gen Z is handling or tackling dating a bit differently, and if that's also just part of the problem. And it seems to be a recurring theme here that dating apps are, for one, just, a huge upcoming since, I don't know, maybe 2015. But at the same time, they seem to also cause a lot of problems. And that's kind of the problem that you have in this business model. So regarding the safety, what can be done to break those stigmas of being, an unsafe environment for women, but also just to make the user experience better on these apps, especially for women? If you've got such a large number of them reporting negative experiences on these apps, even if they don't all flat out think they're unsafe, that just doesn't seem to be sustainable in the long term.
Over the past few years, dating apps have introduced a few features to tackle these pain points. For instance, some of these apps now commonly have photo verification to reduce fake profiles, and there's AI-based moderation to remove harassing messages, and then there are background check integrations that Tinder has used with a company called Garbo that helps to check for criminal records. And they also have a video chat feature that allows users to have a virtual first date safely from their own home. So that is a great way to save time and filter out bad matches before meeting in person. And there's a lot of work to be done to inspire confidence in the safety of dating apps. But some of these enhancements do genuinely increase user trust in the platforms and should make it more likely for them to stick around after they sign up. And unfortunately, for as good as these initiatives sound, ideas like photo verification have been around for years, where you upload a profile pic, but you also have to submit a selfie in real time, and then they match up the photos to decide if you are who you say you are. So it's not a new idea. And if anything, the rollout has been very slow, which is why I would say that generally Match Group has not been an operationally excellent or innovative company like some of the other businesses we've looked at together. And that's not to say it can't be a decent investment at the right price, but we do have to be honest with what we're working with here. Using photo verification was not only a big part of the 2024 product roadmap, but it dates back all the way to 2019 earnings calls where management said, and I have a quote here, they said the following: "The second thing we introduced is photo verification, debuting on Tinder. Members can self-authenticate through a series of real-time pose selfies. These selfies are then compared to existing profile photos using human-assisted AI technology. Profiles with verified photos will display a blue checkmark, and the feature is currently testing in select markets and will become more widely available this year." So 5 years later, they were still teasing the rollout of what should be a helpful feature. But I mean, we're not talking about rocket science either. I mean, I don't know why this would take 5 years to roll out.
It is surprisingly lackluster pace of introduction for, you said it, for what should be relatively urgent safety and security features. It seems like a no-brainer to get this done as soon as possible. So I'm kind of asking myself, is it really just a lack of operational excellence, or is there something in the background? How do you explain this to take 5 years?
I do have a theory. I've been reflecting on this a bit and have spoken with some other investors who follow Match. And I just can't help but wonder if I'm overlooking some of the incentives the company may have to actually roll out these features more slowly. As in, if you think about it, some of the bad actors on these platforms who do things like, spam women with messages and harass them, they also may be some of the biggest spenders on these apps. And we talked about how concentrated spending is here. And I'm guessing, but the people who are most addicted to the gamification of online dating and are spending an order of magnitude more than other paid users, maybe they don't have entirely good intentions. And at a minimum, maybe they just have some obsessive tendencies. And so there's really no nice way to say what I'm trying to say, but you can probably figure out what I mean. And Match may have realized that some of their most troublesome users are also by far their most profitable. Or even beyond that, you could have accounts that are maybe female that pay for a lot of promotion on the platform for commercial reasons, like trying to use Tinder as a vehicle to promote and draw interest in OnlyFans subscriptions. That is something we've seen a good bit of on Tinder. And so, yeah, I mean, if that's the case, removing these super users wouldn't just pressure Tinder's monthly active user stats, but it also is going to hit revenues and operating profits. And I will say I'm reading between the lines a lot, and I'm at risk of over speculating, but just even the fact that dramatic conflict of interest is plausible, I think is a troubling dilemma for shareholders, because the company's short-term incentives, like reaching quarterly earnings targets, may not actually align, and maybe the opposite of really what's most important longer term in creating the safest and most trustworthy platform possible that would have the greatest earnings power. So that makes me a little bit nervous.
Talking about these super users and maybe the more obsessed ones, if you want to say so, I think you mentioned there are certain subscription models that can cost hundreds of dollars per month. And I think it's not too far off to assume that people who pay those might use Tinder and other apps differently than most quote unquote normal users. And when you have a dynamic where such power users are responsible for the vast majority of your profits, you are, I think, in a pretty bad position as a company. And yet, I've seen some, on the other side of things, very promising stats for online dating too. Something like 35% of online daters have paid for a premium feature at least once. So there's actually a pretty good chunk of people who pay through these freemium models. And actually, I read that in the US, 10% of all partnered couples originally met online. So having 1 in 10 relationships tracing back to Match Group or Bumble for the most part, they're just a lot higher than I would have expected it to be. And it seems like a great endorsement of the product, kind of like you said, when people meet, maybe they marry, and at the end, that's kind of an endorsement to the product, to the company. And it's kind of a bit of backlash to all the negative things that we point out on these apps. And on top of that, you have this trend where globally, people are marrying later and spending more years single in young adulthood. And there was a Cosmopolitan report recently finding that many Gen Z and young millennials are in no rush for long-term partnerships. 38% reported viewing marriage and partnership as optional rather than essential. And that might sound bad for online dating at first, but actually it could extend the period of active dating and therefore mean that people use dating apps in different ways across longer periods of their lives on average. And as you said, the most important customers are not the ones trying to find long-term partnerships. Those are not the ones paying these huge amounts for those apps. I'm pretty conflicted, honestly, because I do see an industry with some really undesirable incentives and realities. And yet I also see an industry that is maybe more promising than most people currently give it credit for. We can buy a stock like Match Group at a very reasonable price, even all things considered.
It reminds me a lot of the Roku pitch from a few weeks ago where there's something really interesting here. Yet it's also hard to get totally comfortable with what you're buying. This is a company that'd probably be much better off being private, where they can be removed from the Wall Street spotlight and stop worrying about quarterly earnings and instead just focus on doing things that maybe will actually hurt the business today, but are crucial long term, like more safety features and removing troublesome users, even if some of them generate the highest ARPUs. And I should say, the key difference from Roku and why I find this even more compelling is that, as you said, the valuation is just so reasonable and the company is so profitable. They spin off a lot of cash and that can be used for dividends. And we saw them announce a dividend for the first time late last year. So without any growth, they can actually generate pretty attractive returns just by returning cash to shareholders. And I think that dividend there is actually a sign that they expect to be a public company and are not planning on going private. And even though I don't have a ton of faith in management really making material improvements in the business, there's always a possibility that they do, or also that the company gets acquired and maybe taken private at a premium to the current price. Even if I don't like all the turnover at the top of the company and don't think they've got the best team of product engineers in the world shipping innovative ideas consistently, they do deserve some credit for what they did with Hinge. When Match first acquired a majority stake in Hinge in 2018, they did so at a valuation of $25 million. And it was the 13th most downloaded dating app in the US. So for Hinge to now want to be the most valuable dating apps in the world, that is a real masterstroke of a deal and the execution of it. And I actually checked the App Store earlier on my iPhone before we jumped on the call, and Hinge ranks above Tinder now for top dating apps. So they took a fledgling dating app and they turned it into a multi-billion-dollar enterprise. And since 2020, earnings per share have compounded at 30% a year, while the total shares outstanding are down 6%. So the earnings have been growing and they're making material buybacks to shrink the share count, even if earnings fell off a bit from 2023 to 2024, which is partly why the market has soured so much on the company. And to put that differently, when you zoom out, there are some things to really like about Match Group. And the picture is probably not as bad as you'd think, given the valuation and the fact that the stock is down almost 70% in 5 years.
I was actually surprised when you first told me you pitching Match Group. I thought it was just a bad business, which is also not, producing so much cash, but they actually are. And if they're producing that much cash, if they're giving back to shareholders, and if the valuation is as good as it seems to be, why don't we start talking more about the valuation part? I think we've danced around it long enough, so why don't you get into the valuation more, show us your model. It sounds like the picture is very mixed, but if your model confirms that the stock is actually as cheap as it looks, then that certainly makes the pitch significantly stronger, right? So where did you land with your model?
One of the things I quickly noticed is that this is a company that does substantial stock-based comp that we mentioned a bit earlier. But when you adjust for that and subtract that expense from free cash flows, Match still trades at an adjusted free cash flow yield of 9%. Meaning if you buy the stock today, 9% of your initial purchase price could be returned to you by the way of dividends or share repurchases within 1 year and so on from there. And as long as the business doesn't dramatically contract, you're buying it at a price where you immediately expect a nearly double-digit return without banking on any future growth. So even if stock-based comp is 30% of free cash flow, there's still plenty of free cash flow otherwise being generated to offer an attractive yield. And obviously that yield is even higher if you use the free cash flow number that's not adjusted for stock-based comp. But I know that's not how we like to roll, Daniel. We like to treat stock issuance as a real cost to shareholders, so we can't just write it off. But looking at the whole business, it's a hard stock to model because you have all these different dating apps under one roof, and some are growing, some are flat, and others are in decline. They all have different trends in being able to extract more or less revenue per paying user too. So without really being an expert on what's going on at Hinge versus Tinder versus OkCupid versus Match.com in Asia, it was hard for me to get comfortable modeling anything that wasn't just a basic extrapolation of what had already been happening at these different segments in the past few years. And with Tinder, for example, which makes up most of their revenues, despite multiple CEOs and waves of new product innovations and safety improvements, they have not been able to arrest the decline in the total number of monthly users on the platform and the number of paid users total. And so something about Tinder just doesn't resonate with people in the same way anymore. And Tinder is basically in free fall at this point. And so it's impossible to say where it will bottom. And it's even harder to predict if and when they can resume growth. So I just tried to modestly assume that some of their new initiatives can slow the rate of decline and they can continue to offset that a bit with higher subscription prices too, while the number of users continues to go down over time still. And conversely, I tried to make conservative estimates for Hinge, showing that the company has a lot of room yet to grow, but decelerating some of that growth over time. And again, I should say that this is a company whose future did a 180-degree pivot from the outlook in 2021 to 2023. So that's why I say I have little confidence in knowing what can happen by 2029. Things can change dramatically again. It could be a growth stock again in 3 years. So anyways, as a base case, I have Match Group compounding revenues at 3.5% a year through 2029, which may be optimistic if Tinder continues to fall off, or actually dramatically pessimistic if the Tinder business stabilizes. So Tinder is really the big question mark. That is the unknown unknown. And so I also wanted to bake in some modest increases in the exit multiple where, assuming Tinder's platform does stabilize to some extent, the market is then going to naturally reprice the company from a multiple that's reflecting terminal decline to something that is at least a little bit higher for a more stagnant version of Match's business. And the point being, without assuming any kind of huge turnaround, really, that they can keep growing Hinge and slow the decline in Tinder on top of the current rate of aggressive buybacks and dividends at pretty low valuation multiples. I don't think on paper it's a stretch to say that it looks like a promising investment. I mean, from today's prices, I suspect this company could generate 15% annual returns over the next 5 years or so without heroic assumptions.
You don't sound too bearish, I might say. So does that mean, you're not sounding too bearish, plus a 15% annualized estimated return, that you would recommend us to add Match Group to the portfolio?
I would just credit the lack of bearishness to the fact that I'm so genuinely conflicted because I keep going back and forth because I mean, to answer your question, no, I think this is going to be one of those cases where I advise that we actually don't go solely off the model, because I think it is really easy to say, yeah, the new CEO can slow Tinder's decline, and maybe that's true or maybe it's not true. Maybe in the same way that Blockbuster or BlackBerry couldn't really be saved, the same is true for Tinder. And from what I've heard in earnings calls and at their investor day, nothing has really inspired me to believe that Tinder is going to turn around in the foreseeable future. And in Hinge, no matter how promising it is currently, has a long way to go before it can fill the hole in Match's business model being left by Tinder. So I have very little confidence in their game plan going forward, other than just generally betting on mean reversion. And that's why I don't think it's appropriate to recommend the company at the moment. And kind of ironically, maybe by next year, if we see signs of Tinder stabilizing, at that point, the stock will definitely jump. But I would rather pay a higher price at that point in time when it's clear that the core business isn't in terminal decline, instead of buying a business where I'm really just hoping the core business doesn't get cut in half in 5 years, even if the valuation, looking at trailing financials, is very attractive and would lend itself to high forward returns.
I guess it's also questionable where Tinder's growth would be coming from. I mean, right now we see Tinder in decline and Hinge is benefiting. But if Tinder starts growing again, is it Hinge in decline then, or is it just the overall industry getting much better? I think there's a lot of uncertainty baked into that. And I mean, Match Group's story over the last 5 years is really a cautionary tale on blindly extrapolating forward growth trends. So getting excited and then paying an outrageous multiple for a company only for the stock to fall 70%, you would think that earnings would have fallen by a similar amount, but it's really mostly just a contraction in the multiple on current earnings. It's not like the business itself has imploded, but the market seems to be expecting that as a possibility, or at least is reacting very negatively as the stock gets re-rated from being a growth bet to basically being a value bet at this point. And yet, for as painful as it has been for Match is much more diversified than Bumble, for example, and the market has recognized that. So even though Match's price to free cash flow multiple looks depressed, it's not bad at all compared to Bumble. And that makes sense because Bumble primarily only has one platform, meaning if for whatever reason Bumble fades in popularity the same way that Tinder has, the company is pretty much dead. And with Match Group, they have a number of other apps to fall back on and have a new growth engine. For example, with Hinge, if Tinder, is not doing so well. But yeah, where Match trades at 9 to 10 times free cash flow, Bumble trades at only 4 times free cash flow. For a company that's expected to continue growing free cash flow over the next 18 months, a 20% free cash flow yield is quite a thing to see. I don't think I've seen that ever before. And to connect it back to Match, even though it sort of feels like the valuation for Match can't contract much further, the stock could get cut in half if the market, is pushing it down to the same multiple as Bumble. So even after a big drawdown that we definitely have seen and a very reasonable valuation at first glance, there's still precedent for much more downside.
As you said, looking at a chart of Match and Bumble's valuation multiples is kind of a scary thing to see. I'm sure no one who bought Bumble in 2021 at 200 times free cash flow
Wow.
thought it would fall to 4 times free cash flow. Even if they knew they were buying at an expensive price, even if they knew they were getting ripped off and paying a crazy premium, who would have thought that it could fall that far? That is almost ridiculous. So yeah, that's where we are. And that is literally what happened. So it's one of those things where you don't want to catch a falling knife.
Absolutely. It's just a hard to understand business and even harder to understand industry. And you know the business better than I do, but I'm kind of glad you don't recommend adding it to the portfolio. It's possible this business will see an acceleration of growth at some point, but I don't think that's the most likely outcome. And to me, it feels like the multiple is not necessarily too low for a company with the problems of Match and just a business model that generally seems to be, I don't know, kind of hurting itself at some point. And if there's no multiple expansion, I doubt that growth alone would deliver a satisfactory return, at least for the returns that we look at. And that's not to say there's no potential upside. I definitely see how this stock could be or could trade much higher, but I don't think it has the same asymmetrical nature as some of the other turnarounds we looked at. I mean, you mentioned a 9% adjusted free cash flow yield, and we got PayPal at an adjusted free cash flow yield of 7.5%, depending where the price is, closer to 8%. So if I see that and I compare the business models, I'm still more confident that PayPal has a better future than these dating apps. Personally, I couldn't tell you why, but perhaps you see it differently. I just think there's more risk involved here.
I think instead of setting this truly in the too hard pile, because sometimes we look at companies and we're like, okay, this is going in the too hard pile, and realistically, we're probably not going to look at this again. With Match, I agree that structurally it's not a great business. Yet at the same time, I think the valuation more than offsets that, such that I want to genuinely keep following the company just because I'm at my own curiosity. Now I feel so invested in the Tinder story. I really want to know if they can turn Tinder around. And at that point, depending on where the valuation is, I think I genuinely would be inclined to consider maybe repitching it for the portfolio, or at least for my personal portfolio. Because I kind of feel like in the intrinsic value portfolio, we're looking for compounders, and this is not necessarily that, obviously.
Yes, I would agree. I think we do not only look for compounders. There are some companies in there where I would say, okay, it's a mix out of a company that could turn around and then continue to compound, or perhaps it's just a good turnaround story. But I agree with you. If I could see Tinder to reaccelerate its growth, and at the same time, it's not at the expense of Hinge, so you basically see both apps doing way better, which would only be possible if the industry itself is having some form of tailwind. I could definitely see how this is way more attractive than it currently is. And as you said, we might pay up a bit in price at that point, but we would have so much more certainty on the long-term outlook. I could get on board with buying the company at those points.
Well, folks will have to stay tuned. I don't think it'll be happening anytime soon, but maybe over the next 12 months or so, we'll get some real clarity on what's going on at Tinder, but maybe we won't. I mean, there's been a couple of years of uncertainty. So that's the problem. I don't know when or if we'll ever get a clearer picture of what's going on at Tinder. Because if it keeps falling 3, 4, 5% year over year, every single year, it's just really hard to get comfortable entering the company. So with that, how about you give us your hints for next week's episode pitch, Daniel?
Well, the company I'm going to pitch next is definitely a lot less controversial than this one. It's probably the least controversial company you could pitch, and it's definitely known by all of you at home. For some reason, though, you still rarely come across pitches for that company. At least I don't see them too often. And anyway, you and I said at some point we have to cover it, and I think it's time for that. It has seen what might be the most polarizing, or at least not popular, but it drew some eyeballs that the CEO announced a transition this year. So I guess there's a lot to talk about in the next episode. And I don't know, in our community, those hints might already be enough. What do you say?
I think knowing your pick, that's a good way to dance around it. So on that note, let me leave you with a quote to close things out. And this is from Mark Twain. And he says, "You can't depend on your eyes when your imagination is out of focus." And I came across this the other day after listening to a podcast about Mark Twain's life, actually. And I just love the quote. And not because Twain was a great investor. He's actually a very bad investor. But because it's so easy for our excitement or our fears about owning a company to distort how we see reality. And what we see when researching a stock can really look different depending on our emotional state at that moment. And given all the stigmas and preconceptions about online dating, looking at a stock like Match Group really requires us to ensure we're truly seeing financial reality and economic reality for what it is, and not being too emotionally biased in one way or the other by the fact that, oh, I used a dating app and I didn't like it, or I used it and that's how I met my wife. I mean, those anecdotes can be helpful, but ultimately I think they blind us more from objectively what's going on than they help. So by the way, we should mention, if you are interested in joining the latest cohort of members being admitted into our intrinsic value investing community, you can learn more at theinvestorspodcast.com/intrinsic value community. And of course, we've got the link for that in the description below in the show notes. And with that, we will see you all again next week.
The idea behind pitching Dell is pretty straightforward. There are three types of companies in the AI space: the ones building the chips, the ones building the models, and companies building the infrastructure, such as Dell.
And that market is growing fast. Dell's AI business grew 50% year over year, but it's hidden by the legacy business of selling PCs.
Yeah, but that's changing quickly. The AI server business is gaining shares so fast that its growth will become much more obvious in the next quarters. And the question is, how value accretive that growth actually is for Dell.